probably comes as no surprise that we've seen, obviously, these secondary flare-ups, and the markets really are, up to this point in time, have to some extent been ignoring the fact that the secondary flare-ups could result in further isolation and shutdowns or partial shutdowns. So although we totally understand that markets are looking ahead into 2021 or the latter part of this year, the last quarter, from an economic recovery perspective, clearly the question mark has to be whether that recovery is on track, and maybe the market's starting to have second thoughts about that. Our underlying thesis still remains the fact, though, and clearly we're getting the commentary from central banks around the world, including the Fed, that they will continue to be providing very supportive policies at the central bank level, as will governments at the fiscal level, supporting jobs and supporting household activity. So, again, we think that the downside is, when I say limited, it wouldn't surprise to see a correction of something between 5 and 10%, but we are not, in our view, not heading back towards the March lows anytime soon.
Okay, so you expect the markets to consolidate rather than to retest those March lows. But if we take some outlying scenarios here, like a contested US election result or potential nationwide lockdowns in certain large economies, they may be outliers, but could that be enough for you to change your theory on that and actually see a big decline in the markets?
We obviously, there are so many moving parts in terms of risks for investors. There's absolutely no doubt about that. You know, the biggest one's clearly been for the last month or so the chance of secondary flare-ups, and now that's starting to emerge. So that's understandably and certainly part of the risks that we are calculating. The other components of the risk is, as a result of the secondary flare-ups, will the economic data be a lot worse than we're anticipating? We know the data is going to be awful for the next quarter, and we're hoping to see it start to improve somewhat in the third or maybe fourth quarter. And of course, then the big risk is potentially the fiscal cliff. When do governments decide to start pull back from the support? But at this stage, with secondary flare-ups, that's a little way off. And so therefore, we really do need to revert our attention to the November election. And certainly in terms of the polls, it could be an upsetting result in terms of for the Trump administration. But I think the polls have not been as accurate in the last number of key elections around the world that we should be relying on them. But there is a chance that, in fact, that President Trump is upset by Joe Biden on election day. And what does that really mean? Well, we doubt a Democratic administration would dramatically change the current stimulatory policy settings for quite a while. Clearly, the big focus is going to be around jobs and household spending. But obviously, in broader terms, the Democratic policies aren't as broadly pro-business or pro-growth as the Trump administration has been. And so maybe markets will start to factor that in a little later down the track. So I think that's certainly a key risk in front of us, along with, of course, the what appears to be the deteriorating relationship between the US and China on trade.
And of course, that relationship between the US and China has been tested in recent weeks. We've seen the Trump administration now hitting out at Chinese tech firms and also threatening the Hong Kong dollar peg. But Martin, I just want you to unpack a little bit more about the likely scenarios coming into the US election in November. Are you saying that a Biden presidency would be bearish for global markets?
Not necessarily in the first instance, Dan. As I said, I think we'll only be passing down the recovery track from the coronavirus impost on economies. And I doubt any incoming new president will be wanting to be upsetting policies in regards to supporting jobs growth and supporting household and business activity. So it may well be that depending on the duration by which the recovery takes place, a first term of the Biden presidency may keep all of those stimulatory policies in place. But I think we just have to recognise that in broad terms, the Trump administration, in terms of cutting taxes earlier on, cutting red tape, spending money on infrastructure and being more pro-business, it is certainly something we have to take into mind in regards to future valuations on markets. But I don't think there's an instantaneous fall-off in those stimulatory policies just because we see a change in presidency, given the circumstances that we're currently under.